Hi guys, good morning all of you. So how are you? I hope you all must be fine. Yes, tell me, how are you? Am I audible? Am I audible? Please tell me. Let me check. Yes, I think. So guys, a very good morning to all of you. I hope you all must be fine. Same with me. So, yes, good morning everyone. Mahesh, Amina, Arjun, Sharat, Pooja, Vishnu, Anila, Zibin. Okay. Yes, guys. So I hope you have already have watched my first lecture, right? You already must have watched my first lecture, and if you are having any kind of doubt, then please ask me. If you are having any kind of doubt, then please ask me so that we can proceed to the further things. Good morning, Rashmi, Binu, Maria. Okay. Guys, just give me 1 minute. I have to fix some screen issues. Just give me 1 minute. Yes. Okay. Rakhi, good morning. So tell me, have you any doubts? Do you want to ask anything regarding yesterday's lecture? Do you want to ask anything regarding yesterday's technical session? Yesterday we have started our, yesterday was the first lecture, and we have started some basics on FR. We have started one chapter, roadmap of Ind AS. I hope you must have read the remaining part of that chapter. Have you done with this part? That roadmap chapter, this chapter, we have read that chapter yesterday, and some of the parts, some of the important parts I already covered, and the rest part was your homework. So tell me, have you guys done with this part? Have you guys done with this chapter? Also today, what is today's agenda? Today we are going to solve this question on going concern. This is the basic question on going concern, right? First of all, then we'll move to the last portion. we'll move to the last portion, that is financial capital maintenance versus physical capital maintenance. These two things are pending in this chapter only. Okay. Rakhi, doubt. What is the difference between settlement value and fair value? See, there is a huge difference between settlement value and fair value. Fair value is the value between knowledgeable parties in an arm's length transaction. Fair value is the price at which a party sells its asset or settle its liability in an arm's length transaction, or we can say in an orderly transaction between the with the knowledgeable buyer. So both the parties are knowledgeable, they cannot influence each other. The price is taken from arm's length transaction. This is the fair value. But settlement value cannot be, settlement value can be the influenced value, right? Settlement value can be used only when we actually want to sell, but we have to sell with some parties at the affected price. That means fair value is not affected. Settlement value can be affected because your company is getting liquidated, you are in a need of money, you are in need of funds, you have to sell your asset. So the buyer may take advantage of this situation. Understood or not? So this is the settlement value. Okay. Next doubt. Anybody else? Next doubt? Please tell me. Done? Yes sir, did homework, doubt. Transition period is previous year of the year in which we adopt Ind AS, so that previous both AS and Ind AS will come. I couldn't understand your doubt. I couldn't understood your doubt. Basically, transition date is the beginning date. Transition date is not the year. Transition date is not the year. Transition date is the date as on beginning of previous year. So my current year is financial year 21-22. In this financial year, I am adopting Ind AS first time. So what is my previous year? 2021. So what is the transition date? The beginning of 2021. That means 1st April 2020 will be the transition date. But still I couldn't understood your doubt properly. What you actually want to ask? And other students are not replying me. They just written good morning sir. So other students, as far as other students are concerned, I am asking everyone, have you read that yesterday's part? Yesterday's homework part? Everyone, please reply me so that we can proceed further. Have you read that yesterday's remaining part, which was your homework? In 2021 we prepare both AS and Ind AS. See, actually our original 2021 financial statement has already been prepared by AS only, and it is being audited by auditors, and it is being taken in the shareholder, it is being taken by shareholders in the AGM also. Okay, but again we have to make Ind AS financial statements only for the purpose of current year adoption. But you can say that will be the unaudited. That will be unaudited. So as far as 2021 is concerned, that means the previous year is concerned, that previous year original financial statement belongs to AS and that is audited. The financial statements have been laid down in AGM also, whatever. But again we have to prepare that year's financial statement based on Ind AS, but that Ind AS financial statement is unaudited. It is prepared just for the purpose of adopting Ind AS in the current year. That's it. Done with the homework part. Read, sir. Pooja, yes, sir. Zibin, yes, sir. Okay. Tell me, Amina. I hope you are clear now. That means, yes, if you can say, we can say that as far as the last year is concerned, previous year is concerned, 2021, we have two set of financial statement. One as per AS, which is audited and laid down in the AGM, and the second one is Ind AS based, but it is unaudited. Okay. Okay, let's move on to this question. Let's move on to this question. The going concern part. The question is basically gives you idea. This question gives you idea about the financial statements which we used to prepare as per going concern, and suppose if we are not assuming going concern for our business, then what will be the impact on our financial statement? Okay, this illustration will give you the idea regarding going concern impact. Going concern impact, right? Okay, come to this. I am starting this, okay? Example on going concern. Balance sheet of a trader on 31st March 11 is given below. Non-current assets, property, plant and equipment, inventories 30,000, financial assets, trade receivables, other assets, cash and cash equivalents. Equity and liabilities, equity, share capital, other equity, non-current liabilities 10% loan, financial liabilities में trade payables. Okay, additional info. The remaining life of the property, plant and equipment is 5 years. The pattern of use of asset is even. The pattern of use of asset is even. Okay, that means SLM. They are talking about SLM. The net realizable value of the property, plant and equipment on 31st March 2012 was 60,000. Okay. Now, why they have given us the net realizable value? Is it required? No, actually. As far as property, plant and equipment is concerned, NRV is not required. But suppose you are preparing the financial statements by not assuming going concern. Suppose your financial statements are being prepared without going concern assumption, then what will you do? Definitely, when you are going to prepare the financial statements without going concern assumption, that simply means that your business is going to be seized, that your business is going to be closed. So you have to sell your asset. You have to sell your asset. You have to settle your liabilities immediately. So in that case, as far as property, plant and equipment is concerned, when you prepare your financial statements based on going concern assumption, please ignore this NRV. But when you prepare the financial statements without going concern assumption, please ignore the depreciation. Your value of property, plant and equipment is 65,000 opening value. You have to show the property, plant and equipment at 60,000 in your balance sheet. That balance sheet is without going concern assumption. That means 5,000 depreciation only. Tell me guys, have you understood this point? See, we need to prepare two set of financial statements, with going concern, without going concern. Point number one, if with going concern is there, ignore NRV. NRV is of no use because your business is not going to be seized. But without going concern case, ignore the above depreciation, ignore the above number of years, 5 years, ignore the pattern of the use of asset is given, ignore the depreciation method. Just consider the NRV of the asset. Why? Because you have to realize this settlement value. Settlement value, this is the NRV. Settlement value, you have to realize this immediately because your business is going to be closed. You have to realize the asset to settle the liabilities. So this realizable value is 60,000. Tell me guys, understood or not? Understood or not? The second point. The traders purchase and sales in 11-12 amounting to 4 lakh and 4.5 lakh respectively. That doesn't matter. Whether you are following going concern, with going concern approach or without going concern approach, sales and purchase will never be changed. Sales and purchase will never be changed. Guys, tell me why you guys are not replying? Why you guys are not replying? You are getting my points or not? You are getting my points or not? Tell me. Next one. Please do chat, do communicate with the faculty. Okay, it's a kind request. Please do communicate with me. Whenever I am asking any doubt, I am asking you that are you understanding? Are you getting my point? Please do chat. Please do tell me, right? It will actually motivate me also that yes, students are actually listening to me. Okay. Otherwise, I'll ignore your chat also. Otherwise, I'll ignore your doubts also. Please understand. Okay. The cost and NRV of the inventories are 32 and 40. Now see, we all know very well, as far as inventories are concerned, are Ind AS 2 valuation of inventory, old AS 2 valuation of inventory, both are same and both are having same measurement principles like cost or NRV, whichever is lower. Cost or NRV, whichever is lower. So case number 1, with going concern approach, we have to follow cost or NRV, whichever is lower approach. So what is the cost? 32. What is the NRV? 40. Whichever is lower, 32. That's it. But in the second case, which case? Second case means without going concern approach. We have to consider NRV only, just like PPE. We have to consider NRV only. Whatever the NRV is, whether it is higher or it is lower, we have to consider NRV only. Because our business is going to be seized, we have to sell it in any condition. So this 40,000 NRV is to be taken without going concern approach. Guys, understood? Okay. This is the third point. I have covered first three points. If you are having any kind of doubt, you want to ask anything, you can continue to ask me. The next thing, employee benefit expense for the year amounting to 14,900. Basically, it is the expense. It will not impact whether it is your going concern assumption or not going concern assumption. Other assets is written off equally in 4 years. Yes, this will impact in 4 years. When we are saying that we will equally write off in 4 years, so we are assuming that our business is going to be continued in the 4 years. That means we'll take 4 years only when it is our going concern assumption. But as far as without going concern assumption, we don't write it off equally in the 4 years. We write off immediately. So as far as this other asset is concerned, where is the other asset? Other asset means this one. What to do? With going concern, $2,500 write-off and $7,500 carry forward. Without going concern, fully write off. Why, sir? Because as far as 4 years are concerned, when we are not assuming our going concern, that means our business is going to be closed. So why to write off equally in 4 years? It is to be written off immediately. Understood? Next one. Trade receivables on 31st March 2012 is 25,000, of which 2,000 is doubtful. 2,000 is doubtful. Okay. Collection of another 4,000 depends on the successful reinstallation of certain product supplied to the customer. Depends on the successful reinstallation of certain products supplied to the customer. Actually, earlier we had supplied some products to the customer, but we couldn't collect 4,000 rupees from that customer because the installation is pending or reinstallation is pending. Suppose we are assuming the going concern, definitely we would like to collect this 4,000 by reinstalling the product again. But suppose if we are not assuming our going concern, we'll ignore this. Because we are going to close our business. Why to make a reinstallation of certain products which are already supplied? We'll ignore this. So with going concern approach, we will definitely going to reinstall the certain products which have been supplied already and will be able to collect 4,000. But as far as without going concern approach, we'll ignore the reinstallation of certain products which have been already supplied and we'll assume that our 4,000 is going to be bad. Tell me, understood or not? Sir, what about this 2,000? This 2,000 is common for both the situations, with going concern, without going concern. 2,000 is doubtful. Okay. So as far as this trade receivable is concerned, with going concern, without going concern. Trade receivable 20. 20 minus 2, 20 minus 6. Provision. Trade receivable. Understood or not? This way we have to show, we have to present. Tell me guys, understood? Sorry, 25,000. Sorry. 25. 20,000 was the opening figure. Yes. 25. Sorry, my mistake. Okay. Next is cash balance as on 31st March 12 is 37,100 before deduction of interest paid on loan. Interest paid on loan. So what is the loan? 10% loan. So interest will be 3,500. Okay. There's an early repayment penalty of the loan is 2,500. Now, please tell me the treatment of this early repayment penalty of 2,500. What should be the treatment? How will you consider this 2,500 in with going concern approach and without going concern approach? Tell me. With going concern approach and without going concern approach, how will you treat this 2,500 early repayment penalty? Okay, I am waiting for you. Rakhi, doubt. Can you repeat the point once more? Which point, Rakhi? Be specific. Trade receivable. Trade receivable you are asking. Which point? If you are asking trade receivable, then they are saying that there is 2,000 doubtful, which is general doubtful. As far as another 4,000 is concerned, which is to be collected from debtor, they will give us only when we will give another service to them. Now we are assuming that in case number 1, that is with going concern approach, we will definitely going to serve them and would like to collect the 4,000. But as far as without going concern approach, we are not going to serve, we are not going to give the service to them for reinstallation. That means our 4,000, another 4,000 are going to be bad, are not to be collected. There is an early penalty of the loan 2,500. Amina, penalty in CG approach written off and not CG add back. Achha. What about others? What about others? What about others, guys? See, 2,500 is the penalty payable if you are settling the loan early. Now, in going concern approach, with going concern approach, you are not going to settle your loan. If you are going to continue your business, your loan will be continued. Your loan will not be settled early. So there will not be any penalty. Ignore. But in case 2, without going concern approach, you are going to cease your business, you are going to close down your activities, you have to settle your loan immediately. That means early. And in this case, 2,500 penalty will be payable. So this 2,500 we need to provide for without CG, we need to provide for penalty expense debit to loan 25. That means this penalty will be added to the loan and this penalty expense will be booked. But in with CG approach, with going concern approach, it is to be ignored. It is to be ignored. If not a going concern, early repayment penalty should consider. Very good, Zibin. Binu, early repayment penalty may or may not be paid in CG. Without CG, it should be paid immediately. Yes. Okay. The profit and loss account and balance sheet of the trader are shown below in two cases, assuming going concern, not going concern. Okay. Guys, there is one issue. Trade payable. Actually, the one information is missing. The opening trade payable is given, but they haven't given us the closing balance of trade payable. So assume, what is the closing trade payable balance? 12,000 it will be. Yes. They have assumed the balancing figure. Either you can assume this as balancing figure or you can assume that such information would also be given in the question. Now, please understand how we will prepare with going concern or without going concern. First of all, let's concentrate on profit and loss account. First of all, the sales and purchase portion. The sales and purchase portion. It doesn't matter with going concern, without going concern, same figures. So 4 lakh, 4.5 lakh. So 4.5, 4.5, both the cases, case 1, case 2. Sales, both the cases same. Sales in both the cases are same. Purchases in both the cases are same. Okay. Right. Now, point number one, depreciation. Point number one, depreciation. Your property, plant and equipment opening balance was 65,000. 65,000 divided by 5 number of years with going concern approach. So the depreciation would be 13,000 in case 1. 13,000 in case 1. Case 1, 13,000. Depreciation. Case 1, case 2. 13,000. Now case 2, when we will take 60,000 as NRV for PPE and the opening balance is 65, that means the depreciation will be 5,000 only. Other assets with going concern approach, you are going to write off 2,500. So this will be added here just like depreciation. So total depreciation and amortization will be 2,500 in case 1. One is depreciation on PPE and the other one is other current assets to be written off. But in the second one, entire 10,000 is to be written off. So total will be 15,000. Now please check 15,500 and 15,000. 15,500 and 15,000. Understood? Next, sales done, cost. Okay, the cost NRV of the inventory 32 and 40. Now see, in case 1, inventory. Closing will be 32. How much will be the opening? Opening as per the balance sheet will be 30. The opening will be 30. So there is 2000 called change in inventory. Change in inventory 2000 in case number 1. But in case number 2, closing will be 40,000 and opening is 30,000. So your change in inventory is 10,000. Change in inventory 10,000. So 2000 and 10,000 change in inventory. See, 2000 and 10,000. Now if you will ask that, sir, why they have taken these figures negative? Why they have written negative figures? Because this change in inventory comes under expense column, expense side, and it is basically the income now, because the closing is higher, opening is lower, so it is basically the net income, but you are showing this net income on the expense column, so it will be negative expense. Negative expense means income. So 2000 negative expense means income. Clear? Okay. Employee benefit expense for the amounting to 14,900, doesn't matter, both the cases will be same. 14,900, 14,900. Okay. Trade receivables, 2000 is doubtful. Yes, 2000 is doubtful in first case, 6,000 is doubtful in second case. So 2000, 6,000, provision for doubtful debts. Okay. Cash balance doesn't matter. Yes, before the deduction of interest paid on loan. 3,500 is the interest paid on loan. So in case number 1, interest paid on loan is 3,500. But in case 2, interest paid as well as penalty payable expense, both are to be added. So 35 plus 25, 6,000. See, 6,000. This 6,000 means 3,500 interest and 2,500 will be penalty. Understood? So in this way, your P&L becomes over. P&L has been prepared, and finally you got profit as per with going concern approach and without going concern approach. Please tell me if you guys are having any doubt, then you can ask. Please tell me. Then we'll proceed to the balance sheet part. If you are having any doubt, please proceed to the balance sheet part. Please ask the doubts and then we'll proceed to the balance sheet part. Penalty point, right? See, 2,500 penalty is payable in case of early settlement of loan. Now, when you will settle the loan early, obviously in without going concern approach, you have to settle the loan. So you have to pay it. But currently it is payable. In without going concern approach, you have to provide it for. You have to make the provision of this 2,500. So we made the provision. This is the provision. How the provision is made? Penalty expense account debit to loan or to penalty payable, whatever. See, loan, I have added this to the loan, that means I have made the provision, and penalty expense debited. So expense is to be charged to P&L along with the interest. charged to P&L. So it is being charged to the P&L. It is being charged to the P&L. Understood? Depreciation calculation without CG. See the depreciation calculation without CG. 5,000 depreciation, that means 65 minus 60, 65 minus 60, and 10,000 write off fully. Other assets. ठीक है? Yes. Now what about balance sheet? Balance sheet. First one is PPE. With going concern approach, the opening was 65, the depreciation was 13, 65 minus 13. The closing figure would be 52. But without going concern approach, it should be shown at NRV 60,000. It should be shown at NRV 60,000. Okay. The next figure is inventory 30, but the closing figure would be in with going concern approach, cost or NRV, whichever is lower, that means 32,000. But in without going concern approach, it should be at NRV 40. Trade receivables like yes, these are the trade receivables. 25 minus 2, matlab 23. 25 minus 6, matlab 19. So trade receivables will be 23 and 19. 23 and 19. Okay. Okay. Then other assets. 7,500 in first one, 0 in the second one. Simple. Cash. The last one is cash. The cash balance is already given 37,100, but before interest paid it is given. So 37,100 minus interest paid, interest figure was 3,500, right? So minus 3,500. So 33,600 in both the cases. 33,600, 33,600. Penalty is added to the loan as a provision. It is not yet paid. Penalty is not yet paid. It is not to be deducted from the cash balance. Okay, the next one. Share capital same, 60,000. Then Profit and loss balance 25,000 is the opening, and add 16,100 case 1, add 18,100 case 2. So 25, 16, 100, 41, 100. Okay. Or 18, 100, 43, 100. Okay. Then what about the next one? Loan, 35,000 loan. In case 1, it is 35, no penalty. But in case 2, 35 plus 2,500 penalty, 37,500. The balancing figure is trade payable. That is the balancing figure, trade payable. So these are the balance sheets, these are the financial statements including profit and loss and balance sheets with and without going concern approach. So now you know that how the financial statements look like when we don't follow going concern assumption. Now tell me guys, this is done from my side. The last point, the last concept that remains in this chapter is financial capital maintenance and physical capital maintenance. Tell me, have you guys any doubt? Okay, so the next one is this: financial capital maintenance versus physical capital maintenance. Financial capital maintenance versus physical capital maintenance. Okay. Okay. Financial capital maintenance versus physical capital maintenance. Now, what is this capital maintenance? This is the basic, simple point. It was already covered in your CA Inter, if I am not wrong, CA Inter accounting paper 1. It is a part of CA Inter accounting paper number 1. Frankly speaking, this is not a new thing. This is not a new thing you are learning this time. This is actually becomes a part of your syllabus in CA Inter also. Okay. But we don't remember this, that's another thing, but actually it was part of your syllabus. Now, what is this capital maintenance approach? What is this capital maintenance approach? Here we need to understand, how much capital should be maintained every time to conduct the business considering time value of money. Considering time value of money. If we consider time value of money, how much capital should be maintained in our business? This approach talks about capital maintenance. How much capital should be maintained? Okay, how much capital should be maintained? How much capital should be maintained? Understood? Clear? So there are two approaches. The first is financial capital maintenance. The second is physical capital maintenance. They both consider time value of money, but in a different way. They both consider time value of money in a different way. Okay, na? So let us directly jump to this kind of illustration. Based on this illustration, we'll understand the entire approach. We'll understand this concept. Capital maintenance can be computed under all three bases as shown below. Wait a minute. Wait a minute. I think there is a misprinting in the notes. Please let me check. Yes. Can you please write down or take the screenshot of these two illustrations? Can you please take the screenshot? First of all, take the screenshot of this illustration number 2. Can you please take the screenshot of this illustration number 2? Is it done? Screenshot is done. Now take the screenshot of this illustration number 3. Take the screenshot of this illustration number 3. Done? Now take the screenshot of this illustration number 4. Okay, done. Okay. Now please do read this illustration. Please read this illustration. Illustration number 2. Here we need to understand there are two main approaches. First is financial capital maintenance. The second is physical capital maintenance. But before understanding these two approaches, we need to understand the historical cost capital maintenance approach also. This approach does not consider time value of money. Time value of money. This approach does not consider time value of money. Right? Time value of money. A trader commenced business on 1st April 2011 for rupees 12,000 represented by 6,000 units of a certain product at 2 per unit. Now see, a trader commenced its business, new business. Then what is this 12,000? 12,000 is the capital introduced. Trader introduced 12,000 of capital in cash. He purchased 6,000 units at the rate of 2 per unit. That means entire 12,000 has been spended. Okay. During the year 2012, that means entire year, he sold these units. Okay, the entire 6,000 has been sold by him at rupees 3 per unit. That means 6,000 into 3. That means he introduced a capital of 12,000. He spent 12,000 on purchase of 6,000 units at rupees 2. Now he sold all the 6,000 units in the same year. The sale proceed becomes 18,000. That means 18,000 has been received. 12,000 has been introduced. 18,000 has been generated. Okay. And withdrawn 6,000. Matlab, they are saying that on 1st of January 2000, the beginning, मान लो beginning, the 1st of January, capital introduced $12,000, but at year ending, capital becomes 18,000. Sir, how? Capital becomes 18,000, but after drawing of 6,000, again the capital becomes is 12,000. So a trader is very happy that yes, I maintained my capital. At least I maintained my capital from the earlier figure. I have introduced the capital in the business 12,000. Still my capital is 12,000. See, still my capital is 12,000. The trader becomes very happy. Okay, not an issue. My capital becomes 12,000 again. Technically, he is wrong. Technically, he is wrong. I am saying that the trader becomes very happy to see this case, like he introduced 12,000 in the business, and also in the end of the year he is having 12,000, the same capital maintained in its business. It is not okay. It is not a proper situation. It is not a good situation. Why? First of all, read the illustration number 12, complete it. Opening equity was 12,000, represented by 6,000 into 2. Closing equity 12,000, like 18 minus 6, 18 becomes the sale proceeds, represented entirely by cash. Retained profit is nil. You don't have any profit because you have withdrawn entire 6,000 rupees, the profit earned by you. The trader can start the next year by purchasing 6,000 units again at a 2 per unit once again and selling them at 3. The whole process can repeat endlessly if there is no change in purchase price of the product. Yes, this is the thing. See, this approach is okay when there is no change in the product prices. But considering the current market situation, we may expect a particular inflation in the price of the product. We may expect a general inflation in the overall market. So this historical cost capital maintenance approach is of no use. A trader becomes happy by seeing that yes, I have still 12,000 capital in my hand, represented by cash, so I can still purchase 6,000 same units at same 2 rupees per unit. This is the thing which you need to consider, that if there is a general inflation in the market, or if there is a product wise inflation in the market, there might be some possibilities that when the trader is going to purchase 6,000 units again, the price will not be 2 rupees per unit. It may be increased. The price may have been increased from 2 to 2.5, 2.2, 2.1, 2.4, 2.8, 3, whatever. The price may get increased. And if the price may get increased with this 12,000, the trader may not be able to purchase the entire 6,000 units. Now try to understand, to purchase again 6,000 units, trader should maintain its capital as per the time value of money, as per the indexation, as per the inflation approach. Guys, do you understand this point? Do you understand this point? Now try to read this illustration number 3. This is the same illustration with time value of money approach. With time value of money approach. Please read this illustration and I will discuss with you. Please read this illustration first of all. Guys, have you read that illustration number 3? In the previous example, suppose that average price index, the average price indices at the beginning and at the end of the year are 100 and 120. Average price indices 100 and 120. That means if the cost was 2 rupees per unit in beginning, it becomes 2 divided by 100 into 120. 120 na? Yes. At end, this cost will be 2.4 at end. And if it will become 2.4 at end, then what effect is to be there? See, the opening equity is 12,000. Opening equity is 12,000, right? Now, what should be the capital to be maintained? What should be the capital to be maintained? What should be the capital to be maintained? See, opening equity at closing price, 12,000 divided by 100 into 120. As per the current index, it should be 14,400. It should be 14,400. But currently, your closing equity is 12,000. Actually 12,000. As per the real example, your actual closing equity is 12,000. But your closing equity should be 14,400. Your closing equity should be 14,400. So there's a deficit of 2,400. So there's a deficit of 2,400. There's a deficit of 2,400. What to do in this case? In this case, in the original example, the trader has withdrawn 6,000. The trader has drawn 6,000 in the form of drawings. He should understand that 6,000 drawing is much more. He should withdraw just 3,600 so that the capital should be maintained at 14,400. If the capital could be maintained at 14,400, the same capital could be reinvested by purchase of goods at a revised price of 2.4, so that same 6,000 units can be purchased. But with this 12,000 capital, if we want to purchase the goods at a revised price of 2.4, 12 divided by 2.4, only 5,000 units could be purchased. So if I want to purchase the same 6,000 units, I have to maintain my capital by 14,400, not 12,000. I have to maintain my capital at 14,400. This is the approach of financial capital maintenance. So financial capital maintenance says that don't be happy by maintaining the same amount of capital as per the earlier. Maintain your capital considering time value of money, considering the general market inflation, considering the general price inflation. If you have earlier introduced 12,000 capital, now you should understand that your 12,000 should becomes 14,400. Your earlier 12,000 of capital should becomes 14,400 as per the current market situation. And to maintain at 14,400, 18 minus 14,400, only 3,600 should be withdrawn. To the extent of 3,600 only should be withdrawn. That means you can say this 14,400 is the BEP, break-even point. Capital should be minimum 14,400 as per the financial capital maintenance. Understood or not? So this is the approach. What about the next illustration? Under physical capital maintenance, there is again a time value of money, but the price of the product at the end of the year is 2.5 per unit. Now here under physical capital maintenance and financial capital maintenance, what is the difference between these two? Financial capital maintenance takes general inflation. It takes general inflation. But physical capital maintenance considers specific product wise inflation. That earlier the price of product was 2 rupees. Now the price of product is 2.5 rupees. In financial capital maintenance, we considered general inflation. that consumer index was 100, now it becomes 120. But in physical capital maintenance, this is more specific to the product only. This approach is more specific to the product only where you are dealing with. Understood or not? Please read the same thing. So now currently the product is at 2.5. That means there is an inflation of 0.5. 0.5 divided by 2. There is an inflation of 25%. So your opening capital, which was 12,000, it should be inflated by 25%. That means your opening capital nowadays, your opening capital should be 15,000. Your opening capital should be 15,000, so that you can further purchase same 6,000 units at 2.5. So you have to maintain your capital by 15,000. So technically the maximum drawing could be 3,000. 18 minus 15. The maximum drawing could be 3,000. So you have to understand, before withdrawing the money, before making drawings, you have to understand how much capital you should maintain. So why this topic is in your syllabus? Just to make you understand that being a promoter, being a professional, how can you give advice to your company about the capital maintenance? How can you give your advice to the company about capital maintenance? Understood or not? You have to understand that to maintain the capital, you have to consider the time value of money. So before making drawings, before distribution of profits to the shareholders, you have to recalculate your current capital that should be there in the business. After that, you can calculate the balancing figure of distribution or drawing, and you can distribute accordingly. Understood, guys? So this is the thing you can summarize. This is the summary of the entire solution. Please ask any doubt if you have. This was the illustration number 3 and illustration number 4. Please ask the doubt if you have, and if you allow, we can further proceed to the next topic. If you allow, we can further proceed to the next topic. Clear? So the question is to find how much of profit to be retained to be at break even level in future. Yes, obviously the question is how much profit we need to distribute and how much profit to be retained to maintain the capital at break even. Okay, you can read these two things for the theoretical, for the examination purpose. You can read these things. Okay, chaliye. So 2 chapters, roadmap and framework are done. 2 chapters, roadmap and framework are done. Now, there is one topic which is, there are two topics basically. One is schedule 3, and one is Ind AS 1. Both are interlinked. Basically both the topics are interlinked. Okay? Both the topics are interlinked. Again, I must say, since these are the initial classes, this is the day 2. This is the reason I am taking these few topics, few basic topics, just to make you understand, just to make you feel comfortable in this batch, right? But it is your prime responsibility to cover these basic topics in detail. I have given you the notes. If you are taking my notes only, if you are considering my notes only, then it will be sufficient, not an issue. But please make sure that you are reading each and everything in detail from these notes. Okay. So now, which method is better? Obviously, physical capital maintenance. Physical capital maintenance is better, but it depends on the judgment of the company. Somewhere physical capital maintenance, and somewhere financial capital maintenance can also be better. Like financial capital maintenance can be better where the company deals in huge variety of products. So it is very impossible to make the calculation on product wise. So companies used to take general inflation. But physical capital maintenance, where the company is dealing in one particular product only. The company is totally dependent on that product only. So you can take physical capital maintenance. Okay, now please come to this topic. Schedule 3. Schedule 3 of Companies Act 2013. First of all, please understand, Schedule 3 has 3 different categories, 3 different divisions. Division 1, Division 2 and Division 3. Schedule 3 has 3 different divisions. Schedule 3 has 3 different divisions. Division 1, Division 2, Division 3. Division 1 is for those entities who are required to follow AS. Those entities who are required to follow AS and prepare AS based financial statements. Division 2 is for those entities who are required to follow Ind AS. So division 2 is for those companies who are required to follow Ind AS based financial statements. Guys, division 3 is for banks and insurance entities. So now, in our syllabus, division 1 is not there, division 3 is not there. We are going to understand just a one division, that is division number 2. Why? Division 1 was already covered in CA intermediate syllabus, AS based financial statements. Division 3 is not yet active because the banks and insurance companies has not yet adopted the Indian accounting standards. So basically division 2 is there for your syllabus. Okay. Sir, is there any difference between division 1 and division 2? Yes, there is a difference. There is a difference in presentation part. There is a difference in presentation part, formatting part. So basically there is a difference between division 1 and division 2. Okay. Now please understand, division 1 and division 2, one basic difference in format of balance sheet is under division 1, balance sheet starts from equity and liabilities first and then comes to assets. But in division 2, balance sheet starts from assets first and then comes to equity and liabilities. So the format is just reversal. Here we start preparing balance sheet with asset figures, all the asset figures will be there, and then equity and liability figures. Sir, just a single difference only? No. There are so many differences, presentation based differences, but I am telling you just one basic thing. So we are going to understand the division 2. Okay? Okay, sir. Failure will never overtake you if your determination to succeed is strong enough. So division 2 is there, right? Division 2 is there for your what I can say, for your syllabus. Division 2. Financial statements of companies whose financial statements are drawn up in compliance with company's Indian Accounting Standard Rules 2015. Now, why they are Rules 2015? Because the notification came in the year 2015 only. Notification date yesterday, 16th February 2015. So it becomes Rules. Company's Indian Accounting Standard Rules 2015. Sir, what about AS? Old AS, Companies Accounting Standard Rules 2006 for division 1. Companies Accounting Standard Rules 2006. Okay. Acha. Now first of all, please do read all these points. I am just taking one important point, that is rounding off. Rounding off. Come here. Rounding off, depending upon the turnover. Yes, it depends on turnover. Yesterday, the Ind AS compliance, Ind AS phase-wise compliance was based on net worth. You remember? Was based on net worth. Division 2 says, when you are preparing your financial statements, the figures can be rounded off. The figures can be rounded off. Yes. Now, you can follow these rounding off rules depending on the turnover. The figures appearing in the financial statement shall be rounded off as below. The figures can be rounded off in the financial statement, like in the balance sheet, in the P&L, in the cash flow statement. You can round off the figures based on the turnover threshold. If your turnover is less than 100 crore rupees, you can round off to the nearest hundreds, or nearest thousands if you want, or nearest lakhs if you want, or nearest millions if you want. Hundreds, thousands, lakhs, millions. Understood? Understood? Next, 100 crore rupees or more. 100 crore rupees or more. If your turnover becomes 100 crore exact, if your turnover becomes 100 crore or more, in that case, the rounding of rules will start from nearest lakhs. That means 100 and thousands are not there. Nearest lakhs, millions or crores or decimal thereof. Hundreds nahi, thousands no, lakhs, millions, crores. This is the rounding of rule. Okay? So you should remember these rounding of rules depending upon the turnover. If your turnover is less than 100 crore, nearest 100,000, lakhs, millions. If your turnover becomes 100 or more, nearest lakhs, millions, crores. Now please follow consistently. Follow it consistently. It is required by the entities to follow these rules consistently. Like in the last year they followed rupees in lakhs, but in the current year they are following rupees in millions. Please follow it consistently. Okay, na? Once the unit of measurement is used, it should be used uniformly in the financial statement, uniformly from year to year. Understand? Okay. From point number 1 to 3, you have to read by yourself. Point number 5, 6, you have to read by yourself. These are the simple points. This is the format of balance sheet. Here I want to show you some important things. In this format of balance sheet, here I want to show you some important things. See. Some important things. First of all, let's start with the asset. Division 2 starts with asset. Balance sheet starts with assets. Under the asset, there is first heading is non-current asset and the second heading is current asset. There are two main headings. Okay. Now, the subheading. One is property, plant and equipment. You know what is the Ind AS number? Ind AS number is Ind AS 16. Property, plant and equipment, Ind AS 16. The other one is capital work in progress, same Ind AS. Investment property, you know what is the Ind AS number? Ind AS 40. It is governed by Ind AS 40. So first of all, under non-current assets, property, plant and equipment is there, capital work in progress is there. Capital work in progress means under construction building. Investment property, Ind AS 40. Goodwill is there. Now, you know what goodwill is governed by Ind AS 103. Goodwill, business combination. Intangible assets are there. So, Ind AS 38. Why they are saying other? Because goodwill is also intangible. So, they are saying other intangible assets. Intangible assets under development. What do you mean by under development? Self-constructed. You are developing because it is under developing stage. It is work in progress. So comes under Ind AS 38 again. Biological assets other than beer or plant. It comes under Ind AS 41 guys. Agriculture. Ind AS 41. Agriculture. Now see, there is one most important subheading is financial assets. This subheading of financial asset you won't find in division 1. You won't find this heading or subheading in division 1. In division 1 there is no such subheading of financial asset or financial liability. This is the important change in this division 2. Financial asset, and under financial asset there are so many line items like investments are there, trade receivables are there, loans are there, 1, 2, 3. So this financial asset Ind AS 32, 109 and Ind AS 107. These three Ind AS are applicable for financial instruments, financial assets and financial liabilities. Under financial asset, there are three sub line items: investments, trade receivables and loans. Now the next heading is deferred tax asset. Deferred tax asset. Deferred tax asset governed by Ind AS 12. And the last but not least, other non-current, because it is an overall non-current category. Now, so others, other than above, others. No specific Ind AS is there, but you can say that it is a miscellaneous category. As far as current assets are concerned, inventory is governed by Ind AS 2. There is again a heading called financial asset. So the one heading of financial asset under non-current, same heading appears in current assets also. Under financial asset, there is an investment, there is trade receivables, there is cash and cash equivalent, there is bank balances, there are loans, there are others. This is governed by 32, 109, 107. Then current tax assets, it is governed by 12. Basically, it is a tax asset. Tax related assets and liabilities are always governed by Ind AS 12. And the last category is other current assets. It's a miscellaneous category. So more than one Ind AS may come under this. Do you want to write this, or do you want to take a screenshot? Do you want to take a screenshot or write this? Please tell me. Dear, I need to ask Arjun, I need to ask my team whether they have started dispatching the notes or not. Just give me today only, one day only. I need to arrange it. In any case, I need to arrange from tomorrow. If it is not yet dispatched, from tomorrow it will definitely be dispatched. Frankly speaking, as far as my knowledge is concerned, it is not yet, we have not yet started dispatching. But yes, we'll take some actions and definitely we'll start dispatching it from today or tomorrow. Okay, the next thing is equity and liabilities. The next thing is equity and liabilities, okay? Equity and liabilities. Now the next heading, equity and liabilities. Under this, there is first of all equity. First of all, equity share capital governed by the same. Ind AS 32, 109, 107. Yes, because Ind AS 32, 109, 107 are financial instruments and equity is also part of financial instrument. Other equity, Ind AS 32. Although this other equity belongs to so many Ind AS, but more specifically Ind AS 107, 109 and 32. The next one is liability. The next one is liability. Under liability there is non-current liability. There is one called financial liability. See, financial liability. When we were talking about assets, there was financial asset in both the categories. Now, financial liability here in non-current liability and financial liability here in current liability. Under financial liability, there is a borrowing, there is a trade payable. Trade payable are to be subcategorized into total outstanding amount dues of micro enterprise and small enterprise. Creditors other than micro and small enterprise to be subclassified into two categories. Other financial liabilities. Okay. The next thing is provisions. Provision may come under Ind AS 37. Ind AS 37 name is provisions, contingent liabilities and contingent assets. Also, Ind AS 19 can be there. Ind AS 19 can be there. Employee benefits, provision, long-term provision in relation to employee benefits. Then deferred tax liabilities, again tax related items comes under 12. Other non-current is a miscellaneous one. So more than one Ind AS may be applicable. Financial liability again इसमें borrowing, trade payables, same classification between micro and small and other than micro and small. Other financial liabilities. Other current liabilities, provisions, provision again. Ind AS 37 and 19. Current tax liability, Ind AS 12. Okay. So this was the format of balance sheet. If you want, you can take the screenshot of this one. If you want, you can take the screenshot from here to here. Okay. Now please come here in this heading, statement of changes in equity. Yes. Now this is the one of the most important heading, which is called statement of changes in equity. Statement of changes in equity. In short, it is SOCI. SOCI, statement of changes in equity. SOCI. Now what is this? This is basically a working note of equity and other equity. But we need to show it like this. In earlier days, when we used to follow AS based financial statements, the same was prepared not in the name of SOCI, but in the form of working note. Note number 1, note number 2. But now under division 2, you have to prepare it under the name SOCI. Under the name SOCI. This is as good as a working note of equity capital and other equity. But you need to present like this. You need to give the name of this working note as statement of changes in equity. Statement of changes in equity has two parts. The one is equity share capital. The other one is other equity. Okay. Just like you prepare the balance sheet separately, you prepare the P&L separately, you prepare the cash flow statement separately. Nowadays, you have to prepare the fourth part, that is statement of changes in equity separately. That means now balance sheet is a separate thing, P&L is a separate thing, cash flow statement is a separate thing, statement of changes in equity is also become separately shown. It is not to be shown as a working note, it is to be shown as a fair separate thing. So as far as equity capital is concerned, balance at the beginning of the reporting period, changes in equity share capital during the year, changes during the year like issued, buyback, right issue, bonus, and balance at the end of the year. Simply, these three columns are there for equity capital. For other equity, there are so many columns. You cannot understand right now in this class each and every column because they are totally concerned with some other Ind AS. Like there is one column which is share application money pending allotment. Okay. First column is share application money pending allotment. It is not a part of equity capital, but this will be the equity capital after some time when the shares are issued. So this is a temporary category. Okay. Then the next category, equity component of financial instrument, no need to understand right now. This is to be understood in the further classes. The third category is the most important and the most common category of this part, reserves and surplus. जिसमें you have to write capital reserve, security premium, retained earnings, others means other reserves like capital redemption reserve, debenture redemption reserve, investment allowance reserve separately. You have to show all such reserves separately under the sub column. Like this is to be shown like this way: capital reserve, retained earning, CRR, BRR, and so on. Next is debt instrument, no need to understand right now, belongs to Ind AS 109. Next, equity instrument through OCI, no need to understand, belongs to same in financial instrument. Cash flow as reserve, same, no need to understand. Revaluation surplus, you can understand this also. Revaluation surplus, what do you mean by revaluation surplus? You remember in your CA Inter there was AS 10, property, plant and equipment. Earlier the name was fixed assets. So under property, plant and equipment, assets, when you recognize them, when you measure them subsequently on the balance sheet date, you are having two options, either cost model or revaluation model. Either cost model or revaluation model. You remember? So revaluation model is there. So when you revalue your fixed asset, when you revalue your property, plant and equipment, upward revaluation, if you are having any revaluation gain, such revaluation gain is to be booked to the revaluation surplus separately. Exchange difference, if you remember AS 11, AS 11, if you remember, effects of changes in foreign exchange rates. The same Ind AS 21 is there. So whatever the exchange difference was there were two different treatments. In some cases, the exchange difference was directly transferred to P&L, but in some cases, the exchange difference was transferred to foreign currency translation reserve. So this is foreign currency translation reserve. FCTR, foreign currency translation reserve. Other items of OCI. What do you mean by OCI? I will discuss this separately. OCI. No need to understand here. Last, money received against share capital, against share warrant. Money received against share warrant or share capital. Share capital नहीं होगा, share warrant. It should be share warrant. ठीक है? ठीक है? Okay. Now we need to understand the definition of current assets and current liabilities. It is important for the examination purpose also. But before understanding, before taking this, we are taking a short break, right? We are taking a short break. After the break, we'll further start with, we'll continue with these things. So we are taking a break right now of 10 minutes. Break of 10 minutes, right? So I'm coming after 10 minutes. Thank you. Yes, welcome back after the break. So now we are going to understand the definition of current asset and current liability and operating cycle. Shall we start, guys? Are you guys available? Yes, tell me. Are you guys available? Shall we start? Okay. So now try to understand. Schedule 3 has defined the meaning of current assets and current liabilities. Why? Just for the presentation purpose. Because when you know that which asset belongs to which category, you have to make a proper presentation in financial statement, right? As you can see in the balance sheet, there's a non-current category, there's a current category under asset side as well as under liability side also. So you need to understand, you need to know first of all which asset belongs to which category. There are two categories, current and non-current. Now before understanding current asset and current liability, let us first understand the operating cycle. Let us first understand the operating cycle. What do you mean by operating cycle? The operating cycle of an entity is the time. It is the time between the acquisition of asset for the processing and their realization in cash or cash equivalent. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. But this is the secondary thing, that if the normal operating cycle is not identifiable clearly, then you can assume 12 months. Otherwise, what is operating cycle? Operating cycle is, suppose you purchase raw material. Yeah, suppose you have cash. You have ordered the supplier for purchase of raw material. You got the raw material. The raw material has been processed. Okay, and it is being converted into finished goods. The finished goods has been stored in the warehouse. It is being sold to the customer. Sold to the customer, and debtors gave us the cash. Please don't look at the design of the diagram. Obviously, it is not looking good. But yes, try to understand. Operating cycle means every business may have some operating cycle. Like from production, from cash utilization to cash conversion. Right? It is a cycle. This cycle may be of 3 months. This cycle may be of 6 months. This cycle may be of 1 year. This cycle may be of more than 1 year. Yes, of course, more than 1 year. Understood or not? If we take an example of Institute of Chartered Accountants of India, from students' revenue, the cycle can be of 6 months. Understood? So this is called as operating cycle. This operating cycle can be 3 months, 1 month, 4 months, 6 months, 12 months, whatever. It can be even more than 12 months. This is the operating cycle. Understood? Now, I am starting with current assets. What do you mean by current asset? An entity shall classify an asset as current when it satisfies any one condition, not all four. any one condition, when it satisfies any one criteria. An entity shall classify an asset as current when it expects to realize the asset, intends to sell the asset, intends to consume it in its normal operating cycle. Suppose my normal operating cycle is of 12 months. So if I'm expecting to realize within 12 months, it is my current asset. If I'm intending to sell within 12 months, it is my current asset. If I'm intending to consume it within 12 months, it is my current asset. It totally depends on the normal operating cycle. Now let's again deal with this point in detail. Now I'm reading this point once again. It expects to realize the asset. Cut it down. For temporary, I have cut it down. It expects to realize the asset in its normal operating cycle. Now, in which respect they are asking? They are saying expects to realize. Basically here they are, when they are saying expects to realize. When they are saying expect to realize, then they are saying in relation to debtors or trade receivables. Trade receivables. So basically, they are asking for debtors expect to realize the asset. That means I want to realize my money from the debtors. It is expected to realize within normal operating cycle. If I am expecting to realize the amount from my debtors within 6 months, and suppose my 6 months is my normal operating cycle, such debtors will become my current asset. Otherwise, they will become non-current asset. Now again, it intends to sell. It intends to sell in its normal operating cycle. Now, what do you mean by intends to sell? Intends to sell. Basically, they are telling about inventory and more specifically finished goods. Intends to sell. Basically, they are talking about inventory and specifically finished goods. So, intends to sell. An entity shall classify an asset. Inventory is an asset. Finished goods are the asset. As current when it intends to sell. मुझे पता है. I know very well. I know I want to sell it within my normal operating cycle. I have an intention to sell it within my normal operating cycle. Okay? Within my normal operating cycle. And the last, it intends to consume in the normal operating cycle. Here, intends to consume means what? Again, inventory, raw material. Intends to consume, inventory, raw material. So tell me guys, the first point is clear or you have any doubt? The first point is clear or you have any doubt? Tell me. Tell me, is it clear or not? It is clear or not? Okay, next one. It holds the asset primarily for the purpose of trading. It holds the asset primarily for the purpose of trading. Here they are talking about investments. Investments, when you are holding the investments for trading purpose, suppose you are holding the equity instruments, you are having your investments in derivative contracts. So here they are talking about investments primarily for the purpose of trading. Here they are talking about investments for the purpose of trading. This will become your current asset. Any asset you are holding it for the trading purpose primarily. Primarily here primarily means what? Primarily means ordinary course of business. Ordinary course of business. Or primarily means what? Primarily means the main activity. One of the main activity. Understood? 2 points are clear. Any asset will be treated as current if entity expects to realize that, intends to sell that, intends to consume that in its normal operating cycle. Second, if the entity hold such assets primarily for the purpose of trading, it comes investments can come under this. Third, it expects to realize the asset within 12 months after the reporting period. This is a general category. Like all the advances you have, all the loans or advances you have provided to your staff or directors or some other companies, some other parties, they are talking about that. Loans and advance. Moreover, यहाँ पर loans and advances. We are talking about loans and advances. So, expects to realize within 12 months after the reporting period. Within 12 months. Understood? After the reporting period. Sir, what do you mean by reporting period? After the reporting period. Let us say my reporting period is 21-22. So 22 is the balance 31st March 22. This is my reporting date. And after this is the reporting period. Reporting period is the entire period. This can be 12 months, 3 months. After this period, I am expecting to realize within 12 months. So these three are the important things. Now the last and most important, I want to ask you, can you please tell me about this? Can you please tell me about this? Please read this, understand this, and please discuss on this. Explain this point to me. Fourth number, please explain this point to me. Guys, I am waiting for this fourth point explanation from your side. An entity shall classify an asset as current when, point number D, the asset is cash or cash equivalent, unless the asset is restricted from being exchanged or used to settle a liability. settle a liability for at least 12 months after the reporting period. I think 2 or 3 students are only active in this group. One is Arjun. Basically, Arjun, I'm observing that Arjun is properly active. He's properly actively replying on all the things. He's actively asking the doubts also. Any asset that can be exchanged to settle a liability for at least for the next reporting period is either cash or cash equivalent. Rashmi, it is easily gets liquidated and no liability against the instrument within 12 months. See, first of all, in this fourth point, they are talking about cash and cash equivalent only. They are talking about cash and cash equivalent only. So they are saying that cash and cash equivalent will always become the current asset until and unless such cash and cash equivalent is restricted. Such cash and cash equivalent is restricted. Again, in fourth point, they are just talking about cash and cash equivalent. Amina, no change had been created against the, no charge had been created against the asset and it can be converted to cash. First of all, let me clear you. In this fourth point, they are not talking about any other asset. They are talking about cash and cash equivalent only. So they are saying that generally the cash and cash equivalent is a current asset. What they are saying? The asset is a cash or cash equivalent. Then it is a current. Yes. But such cash and cash equivalent cannot be current if it is restricted. For what? It is restricted. See, always treat cash and cash equivalent as your current asset because it is free. How can you use it? You can use it in any way. If you want to purchase any asset, you can use this cash. If you want to settle a liability, you can use this cash. If you want to make any expense, you can use this cash. Because such cash, the cash and cash equivalent is generally free. It is liquidated. It is free. You can use it freely. But restricted like crypto. No. It is restricted. Suppose you are having so many bank balances in your company, but one bank balance has been seized by income tax department. Yes, one bank balance has been seized by income tax department. Now you cannot use that bank account to purchase any asset, to purchase any, to settle any liability, to make any expense. It is seized by income tax department because of some income tax cases. And you are expecting that you won't be able to use that bank account for a minimum period of 12 months. You are expecting that you won't be able to use that cash account, bank account for a minimum period of 12 months. Here, that bank account, you will treat that bank account as non-current because it is being restricted to use. You cannot use it. You cannot exchange. You cannot use it to exchange any asset or settle any liability. Understood or not? Guys, understood or not? Fixed deposit. Someone is asking. Someone is saying fixed deposit. See, fixed deposit. If it is, see, it totally depends the nature of fixed deposit. If it is like it is made for more than a period of 12 months, then obviously you don't want to use it. But can you surrender this fixed deposit? Yes, it is not restricted. How can you say that fixed deposit is restricted? Suppose you have made a fixed deposit for 3 years, but still you have the option that you can realize money from fixed deposit before the maturity date. Na? It is not restricted by anyone. Understood? So this is the fourth point about cash and cash equivalent. So I hope guys you are not getting any doubts on this. This is the definition of current assets. Let me revise this. First of all, any asset will become current asset if entity expects to realize it, intends to sell it, intends to consume it in its normal operating cycle. Second, if the entity holds it primarily for the purpose of trading, generally the investments come or derivatives comes under this category. Third is it expects to realize within 12 months from the end of reporting period. Fourth one, when the asset is a cash and cash equivalent, it is definitely or current. Such cash and cash equivalent should not be restricted to be used to exchange any asset or liability, to settle any liability for a minimum period of 12 months from the end of reporting period. If it is restricted for a period of 1 month, 2 months, then again it can be your current asset. Okay. So current asset is done, current operating cycle is done. Now come to current liability part. Current liability has also 4 points, but I believe first 3 points are same. First 3 points are same, just the reversal of above current asset definition. So first 3 points, please read that first 3 points. I will again explain first 3 points, but please try to read this by yourself, then I will explain. Okay. Sinking fund investment, debenture redemption investment. Beta, sinking fund investment and debenture redemption investment are not in the form of cash. Try to understand. These are made out of the profits, out of the profit appropriation. They are having non-cash reserves. These are non-cash reserves. These are not cash. You are asking for, you are saying, investment. Okay. When you make sinking fund investment or debenture redemption investment, it is, but obviously not a cash and cash equivalent. Now, why you are not understanding properly that current asset, fourth point, belongs to cash and cash equivalent category. As far as sinking fund investment, debenture redemption investment, these are the investment. Investment cannot be cash and cash equivalent. They can come under second point, third point, simply. So first 3 points, please read this and I will explain there. Mahesh asked one thing about the seized bank account in your example, where we can actually present the same in financials. You can present this in other non-current assets, simply other non-current assets. So current liability, the first point, entity shall classify liability as current when it expects to settle the liability in its normal operating cycle. Basically they are talking about creditors or payables. Second, it holds the liability primarily for the purpose of trading. Now you will be surprised that why this point comes under liability, sir. Holds the liability primarily for the purpose of trading. Sir, in trading, how we can trade a liability? Here, if you consider some derivative contracts, suppose you are regularly investing your money in F&Os, futures, options, and there can be two positions. Under future, there are two positions. There can be two situations, so not position. Under future, there can be two situations. One is favorable, one is unfavorable. When you are in a favorable situation, you are actually winning the betting, you are winning the game, you are going to realize the money. But suppose you are on the other side, like unfavorable position, you are going to lose your money, you have to pay something. So this is the derivative part. So you can take the example of derivative. It holds primarily for the purpose of trading. So liability can also be under trading, like when you are going to invest your money in derivative contracts and you are going to lose the money. The market is not favorable in your side and you have to pay something, you have to settle some liabilities, and you are doing it on regular basis, regularly. Understood or not? The third thing, the liability is due to be settled within 12 months after the reporting period. It is again same. So these 3 points are same. A, B, C. These 3 points are same. Right? Now, as far as fourth point is concerned, it is very important. Fourth point is very important. Any doubts on above 3 points? Any doubts on above 3 points? Tell me. Any doubts on above 3 points? Any doubts on above 3 points? Tell me, guys. Yes, definitely. Under F&Os, there is another contract, derivative contract, option contracts. Under option contracts, there are two persons. One is option holder, one is option writer. Now see, this is the more specific example relating to derivatives. So somebody who are those students who are comfortable with this example can understand. So option contracts are having two parties, option writer, option holder. Option writer always write the option, write the contract, and it is his regular business, like India Bulls, Kotak Securities. So they are the option writers. So basically they primarily hold the liability for the purpose of trading. So they will definitely come under this category. Definitely under this category, right? Sir, inventories kept in distilleries will come under the current assets, some them kept for years. See, if we are keeping this for some years, yes, or some some kind of wines or what, we are keeping this for 14 months, 17 months, for years. If it is a regular process, then obviously your normal operating cycle will be more than that, na? If you are keeping that inventories in distilleries for storage purpose, so that it could gets better taste, then definitely you are not going to sell it for some years. So definitely there might be some cases your operating cycle could be 2 years, 3 years, 4 years. So accordingly you have to analyze the inventory comes under which category, current or non-current. Still I can say the inventory comes under inventory current asset category. Okay. So the last point. Now the last point, and it is again one of the most important point. I want you to read this first of all, and please explain to me, and then I will explain you again. Okay. I am giving you 1-2 minutes. Yes, Arjun has given a perfect example. Current maturity of long-term borrowing. Very good, beta. Very good. Current maturity of long-term borrowing. You have taken a loan for 10 years. You have taken a loan of 10 years. Now, let us assume every year ending, you have to pay one installment. At every year end, you have to pay one installment. So, when first installment is going to be due, you have to pay it within 12 months, obviously. You are standing at the beginning of the year where you have taken the loan. The first installment is due to be paid within 12 months. And you cannot deny this. You have to pay it. You cannot defer it. You cannot defer it. You cannot postpone it. You don't have any right to postpone it. You should not have any unconditional right to postpone it. There can be a conditional right. Like suppose if you are taking permission from a bank to give you the extra time based on some conditions, that is another matter. You don't have any unconditional right to postpone the settlement of this first installment because it is going to be paid within 12 months. So this will become the current asset. So current asset means entities should not have any unconditional right to postpone the settlement. Defer means postpone. To postpone the settlement for at least 12 months beyond the reporting date. At least 12 months beyond reporting date or after the reporting period. Understood? So any type of liability where you are obliged to pay, obliged to discharge, you cannot postpone it. Suppose if you can postpone, but the postponement may be of 2 months, 3 months. The postponement cannot be there for more than 12-month period. And if you can postpone with condition, then again it is not your current liability. It is not a non-current liability. Understood or not? So ultimately, if you are having right, the right must be unconditional right. Okay. If you are having unconditional right to postpone the settlement of this liability, okay, for a minimum 12-month period, then only you can say that this is your non-current liability, this is not a current liability. If you have conditional right, then again it will be current liability. Entity shall classify all other liabilities as non-current. Any doubt, guys? Any doubt? Tell me, any doubt? So these were the important definitions of current assets and current liabilities in operating cycle. Rest part you have to read by yourself because that is not much important. That is not much important. That is not much important. Okay. So in moratorium, EMIs are not to be recognized here. So in moratorium, EMIs are not to be recognized here. Yes, can say. The rest part you need to cover up by yourself. Like items of current assets are categorized on so many categories. Okay? Equity, non-current liabilities, current liabilities. Under current liabilities, this is important part. Other current liabilities. Under current assets, okay. This is important part. Statement of profit and loss. Have a look on this statement of profit and loss. First of all, revenue from operation is there. It covers from, it is governed by 115. Other income, then there is a total income, then expenses. Expenses में सबसे पहले first of all cost of material consumed. Cost of material consumed. It consists of opening raw material plus purchase raw material minus closing raw material. Then purchase of stock in trade. See, what is the difference between these two? Can you please tell me? What is the difference between these two? The first one is cost of material consumed. The second one is purchase of stock in trade. What is the difference between these two? Basically, this is, they are talking about, here they are talking about manufacturing companies. But here they are talking about trading companies who directly purchase and sales. Change in inventories of finished goods, stock in trade, work in progress. Change matlab here closing minus opening stock. Closing minus opening stock. Employee benefit expense, this is governed by Ind AS 19. Finance cost, this is governed by Ind AS 32. Depreciation amortization, this is governed by Ind AS 16 and 38. Other expenses, total expenses. Profit or loss before exceptional items and tax. Then there is a category of exceptional item. Under division 1, there is a separate category of extraordinary item also. But here you will not find such other category, such separate category for extraordinary item, because under Ind AS there is no such extraordinary category. No item can be called as extraordinary item. There is no such word which is used in Ind AS. Exceptional categories there can be there. Exceptional items. Now, if you ask me the example of any exceptional item, any item of ordinary activity which is exceptionally different from previous year. Like suppose in your business you can assume 3 to 5% of bad debts every year. In your business you can assume 3 to 5% of bad debts every year. But during the lockdown period, your bad debts has been gone to 15%. Yes, and you have to recognize that bad debts. Now the bad debts will be shown as an exceptional item because it is a part of your, though it is a part of your normal activity, but it is exceptionally higher than previous years, than normal years. So this is the example of exceptional item. Profit and loss before taxes, then there is a tax expense which is governed by Ind AS 12, current taxes and deferred taxes. Then profit or loss for the period from continuing operation. Profit or loss for the period from continuing operation. Now here I will tell you one important thing. Here I will tell you one most important thing. Profit or loss from continuing operation. Now try to understand. A business or an entity may have two businesses. Business 1, business 2, right? Business 1 has been discontinued during the year. Discontinued during the year. And it is continuing business. Business 1 has been discontinued during the year. You know what? Ind AS says, also Schedule 3 says, Schedule 3 and Ind AS both says that as far as this business is concerned, you must have some revenue from this business, expenses from this business, right? But since this is a discontinued business, do not show revenue, expenses separately like this. Revenue from operation, other income, expenses, exceptional items, no need to show all these things for discontinued operation. Directly you can show the profit loss from discontinued operation. That means the final results of discontinued operation. That means as far as this continuing business is concerned, These all items are belonging to continuing operation, not discontinued operation. So revenue from operation, continuing. From continuing operations, other income, expenses, exceptional items, profit after taxes, profit before taxes, these all are your profit or loss from continuing operation. As far as your discontinued operation is concerned, no need to show revenue from operation separately, no need to show other incomes, no need to show each and every expense column, no need to show them separately, just show one single figure, which is result, that is final profit or loss from discontinued operation, and tax thereon, That means the profit or loss before tax from discontinued operation, then the tax expense, then profit or loss after tax. So these three things belongs to discontinuing or discontinued operation, and these things belongs to continuing operations, right? Tell me guys, have you understood? Now see, look at this. What is this? This is continuing plus discontinued, like 11, 9 and 12. 9 means this one and 12 means that one. Final profit combined. Guys, have you understood this? So as far as discontinued operation is concerned, no need to show the separate revenue from operations, expenses, वगैरह वगैरह. Tell me, are you getting my point? Tell me guys, I am waiting for your response. I am waiting for your response, guys. Have you understood this point? No. No need to make separate detailed note. No. No need to make separate detail. For this discontinued operation, Ind AS 105 applies. And Ind AS 105 says, just show the results. Just show the results. Right? Now come to the most important one. One more most important point, that is other comprehensive income, OCI. OCI. Sir, what if when no continuing operation? Okay. Sir, what if when there is no continuing operation? Then not an issue. When there is no continuing operation, then you can make a detailed note of revenue from operation from discontinued, revenue expenses of discontinued. Then you can make a detail, because you are basically you are not having not a going concern entity. Basically, suppose if you are not having other continuing operations, that means you are preparing your financial statements last time. Understood, na? Because you have discontinued one operation, you are not having any other continuing operations. That means you are not assuming going concern. So you are preparing your financial statements last time. Now, before concluding today's session, Let me explain about OCI because it is a very important concept. Let me explain about OCI. Let me explain about OCI. Okay, other comprehensive income. Other comprehensive income. See, you remember your IPCC days, CA intermediate days, where you used to read accounting standards. There were some accounting standards, I am telling you the name. I am reminding you some name and some treatment based on accounting standards. Like first, AS10. AS10 says that you can revalue your property, plant and equipment. You can record the revaluation gain not through P&L but directly to revaluation reserve. You remember? You remember whatever the revaluation gain is there, you cannot record that in your P&L. You have to show it in your reserve and surplus and separately as revaluation surplus, if you remember. This was the first AS10. Okay. You remember AS11, effects of changes in foreign exchange rates? You remember AS11, effects of changes in foreign exchange rates? If you remember AS11, you must have remembered the foreign branches, two type of foreign branches, integral, non-integral. You remember? And there was a treatment for non-integral foreign operation that whenever you convert in the entire financial statements of your non-integral foreign operation from foreign currency to Indian currency, from foreign currency to reporting currency, Indian currency, then whatever the difference, exchange difference arise, you cannot transfer that exchange difference directly to your P&L. You have to show it separately under reserves and surplus in the name of foreign currency translation reserve. You remember this? You remember this or not? Okay, one another thing. You remember amalgamation chapter? Amalgamation chapter. You remember internal reconstruction chapter? Under internal reconstruction, there was a capital reduction account or capital reconstruction account. We used to write off our assets from capital reconstruction account, and the remaining balance of, at last, the remaining balance of capital reconstruction account was used to be transferred to capital reserve directly under the reserve and surplus figure. No need to transfer it to the P&L. You remember amalgamation. Under amalgamation in the nature of purchase, where we used to make a journal entry of assets acquisition and compare it with the purchase consideration, there can be a difference. If the debit difference is there, transfer to goodwill. If the credit difference is there, transfer to capital reserve. And such capital reserve is directly transferred to reserve and surplus, not the profit and loss. So guys, try to understand what I am trying to say is, there are so many Ind AS or there are so many AS who talks about that you cannot charge your income, you cannot charge your expense directly to the P&L. You have to show them separately. Just because of the reason that they are unrealized in nature, like revaluation gain, it is not yet realized. How can we show it in our P&L? FCTR, it is not yet realized. How can we show it to the P&L? So the basic purpose why these items were not transferred to the P&L is they were basically unrealized in nature. Understood? Now same thing goes here also. In Ind AS, there are so many things. There are so many things which are not required to be transferred to P&L because of some Ind AS. Because of some Ind AS, you cannot transfer some items of incomes or some item of expenses directly to your P&L. You are not allowed to do this. You are not allowed to do this. Understood or not? So there are so many treatments, there are so many items which are not allowed to be directly transferred to profit and loss account. So what to do? Like Ind AS 16, property, plant and equipment says the revaluation gain should be transferred to revaluation surplus. Ind AS 21, effects of changes in foreign exchange rates, the same exchange difference should be transferred directly to the other equity portion. Now, what I want to tell you is there are some items which are not allowed to be transferred to the P&L. Which are not allowed to be transferred to the P&L, right? Acha, one more thing. For just 1 minute, one more thing. See, the final balance of profit and loss account goes to where it is gone. The final balance of profit and loss account goes to reserve and surplus, that means other equity. See this? This final balance will definitely be transferred to here, reserve and surplus, other equity category. Understood? So, see, technically, whether you are transferring your income or expense directly to P&L, the final balance of P&L will be transferred to the other equity SOKI portion, SOKI of other equity portion. If you are not transferring any item to the P&L, then also it has to be written over here. That means the same SOKI portion. It is the SOKI. So, first of all, please understand this basic point. Whatever income or expense you have, either you are transferring it to P&L, it is transferred, finally transferred to SOKI in the form of net profit. But if you are not transferring to P&L, then you have to transfer it to directly to the SOKI. So, what is OCI? OCI, just like P&L, OCI is the way from where we can route all these items which are not allowed to be transferred to P&L. OCI is a way, rasta, road. P&L is one road. OCI is another road to reach our destination. See, our final destination is SOKI. Our final destination is other equity. Now, there are two ways to reach such destination. One way is P&L. Other way, the new road which is developed by Ind AS is OCI. Whatever items which are not allowed to be transferred to P&L, they should be routed through OCI and transferred to other equity. So, OCI is the basically a route, a road where all such items which are not allowed to be transferred to P&L are transferred here, and then the final balance of OCI is transferred to SOKI in the name of, it can be debt instrument through OCI, it can equity instrument through OCI, it can equity component of financial instrument, it can be cash flow hedge reserve, it can be revaluation surplus, whatever. These all items are shown here, but firstly, when they arise in that year, they first transfer to the OCI statement. So, like P&L is a statement, OCI is also a statement. See, OCI. So, OCI is nowadays a new road to reach your destination. In earlier days, there was no road for these items, and these items were directly transferred to the reserve and surplus category. Now, we have made a new way, new road, new route through which these items can be transferred. And this OCI is again categorized into two categories. Again divided into two categories. One is items that will not be reclassified to P&L. Will not. And the other one is items that will be reclassified to P&L. Will be. Some items are having nature like initially they are not to be transferred to P&L, but when the transaction will be completed, the asset will be derecognized, you can reclassify to the P&L. And some items are those where you can never reclassify it to P&L. So you have to show it separately along with the tax effects. Tell me, have you understood what is the basic purpose of OCI? If in the current year there is one item which is not allowed to be transferred to P&L, I will transfer that to the OCI and the final balance of OCI will be transferred to other equity, and that will be shown permanently or whatever in the other equity section. Tell me, guys, waiting for your response so that we can discuss on your doubts or we can conclude the today's session. Waiting for your response, and please don't leave the session before I am announcing for conclusion. Only 2 students are saying understood. Other students are like not understood. So in OCI, it will be opening plus OCI shown in P&L is equal to closing of OCI. Yes, yes. At last, total comprehensive income, that is profit, final balance and OCI final balance. Then you have to show the EPS for continuing operation, EPS for discontinuing operation, and EPS for total operation. Guys, don't be lazy or don't create your image that you are lazy. Please try to communicate with the faculty, not only me, with all the faculties like this. I already told you yesterday also that communicating with the faculties on a repetitive basis, when the faculty is asking you, it will motivate the faculty to teach in a high quality also. Understand? One student is saying OCI thoda thoda only understand. The simple thing is, beta, those items, if some items, if you are not allowed to transfer them to P&L, you have to transfer them somewhere else now. So you have to transfer them directly to other equity. But nowadays, directly transferring them to other equity is not allowed. You have to show them separately. So make one separate statement apart from P&L statement. That statement is known as OCI. Those such items will be transferred to OCI first. Final balance of OCI will then be transferred to the other equity part. Yes, right, Amina. Yes, right. The rest part of this topic you have to understand by yourself. Okay, the rest part of this topic you have to understand by yourself. I have covered this schedule 3 topic, right? The rest part you have to understand by yourself. Now one more topic remains, which is Ind AS 1. I am giving you homework to read this entire Ind AS, before yesterday's session. As much as you can, please read this. It is moreover same as schedule 3, but yes, some things are different. But yes, from tomorrow's session, I'll discuss bit of this part. I'll discuss some of the important points of this Ind AS. Then from tomorrow only, I'll start a proper technical session of our main course portion, like we'll start with Ind AS 12, right? So first of all, I'm giving you time. Do read this Ind AS 1 before yesterday's session as much as possible. Tomorrow, I'll take some important points from this Ind AS in the session. Take a break, and after the break in tomorrow's session, I'll start a particular topic, a very most important topic, Ind AS 12. Yes, now, before concluding the session, I have already made a Telegram group for this batch. Some students have already joined that group. Those who are listening to me right now and haven't yet joined that group can WhatsApp me. WhatsApp number 7887788705. They should be registered with the batch. This batch, they should be the registered students. Then only they will be added in the Telegram group, right? This Telegram group is temporary for this session only, for this batch only. Once the batch will become over, this Telegram group will be deleted. The Telegram group will be deleted. So anybody of you who is not in that Telegram group can message me directly, WhatsApp me 7887788705. I'll share with you the link of Telegram group, and you don't need to share with that link with anybody else. Okay? Understood? And yes, I need your feedback how the classes are going on as far as these two classes are concerned. Are you understanding properly or not? What is the basic problem you are facing till now, or how you are enjoying the lectures? Please do tell me. Please do WhatsApp me your feedback, right? If you are having any other issue, or if you want to give me your advice regarding this class, how we can conduct, you can definitely, you are most welcome, right? Okay, so shall we conclude this session? Shall we conclude this session? Okay guys, so bye bye. Thank you so much for listening to me. Thank you so much. Bye bye. Jai Mata Di. Allah Hafiz.